Hello, listeners. Welcome to this episode of Cryptonomics. Before we jump into today's discussion, please keep in mind this recording is for general education and is not intended to constitute investment advice. Any opinions expressed are those of the participants and do not necessarily represent those of Withum. Hello, everyone, and welcome back to Cryptonomics brought to you by Withum. I am your host, Mark Eckerly, and today our guest is my colleague, Ryan Babiak, who is a tax partner here in Withum's emerging technology practice, and I would personally say our resident crypto tax expert within the firm, but that's just me. That said, welcome to the show today, Ryan.
Thanks, Mark. You gave me a lot to live up to there.
It's just crypto and taxes, nothing to worry about.
No.
So you and I, Ryan, we work, I would say, pretty closely together on a regular basis, even though I am an auditor by trade. You are a tax partner by trade. So different sides of the equation, but when it comes to crypto, I think we work pretty closely hand in hand. And basically, since my first day at Withum here, we've been doing webinars, podcasts, all types of marketing materials, just kind of educating the ever-evolving landscape that is digital assets, I would say.
Yeah, it's that's a key word there, education, right? Because you're right. Since you got here, we've been working together. And there was a period of time there when we were all sitting at home that you and I were on how many calls a week together with opportunities for companies that were, had just formed, the day before, a week before, a month before. Would you say probably average one a day there for a few months?
That crypto winter in 2018, 2019, it was new leads every single day, right? And it was always on the tax side, which is it's the right segue into today's episode because right as we're rolling into Q4, tax is on the forefront of everyone's mind. Tax planning, tax strategy.
And finishing up compliance for people who get their returns done, closer to the deadline, wait on K1s and all that stuff. Yeah, agreed.
Exactly. And we really see topics that really run the gambit, right? So questions ranging from the simplest transactions with new users entering the space, right? And I sell crypto. How does that roll up into my 1040 or my 1120 if you're a company, all the way to, hey, I have some staking income or I bought an NFT this year. What's the tax consequences there? Do I have a tax liability? So we're going to be diving into all of that today. And I don't want to steal any of your thunder. I would say I know just enough to be dangerous when it comes to taxes, but I'm by no means an expert. So I kind of want to take it from the top, right? Can you give us the 101 for crypto tax liabilities? What triggers a taxable event? Is it when I purchase crypto with US dollars? Is it when I buy Ethereum with Bitcoin? And how does that ultimately end up on my tax return, right? What is the end result there when I'm first entering the space, and what triggers a taxable event?
Sure. Yeah, happy to address that. And I mentioned, getting educated on all this before. I've told plenty of people when we do our little pitch on a call or just having a conversation at a conference or something like that, that all accountants had to kind of educate themselves for a while on how this whole landscape worked. But Crypto Tax 101 goes all the way back to IRS Notice 2014-21, which I think even you and many non-tax professionals in this industry know exists by now. It was in an Internal Revenue Bulletin, April 14th, 2014, so the day before the tax deadline. I guess that's topical. Also happened to be exactly 2 years before my daughter was born, and that poor kid has a father who was looking to add some excitement to the world of taxes by having a daughter closely born on dreaded April 15th. So what Notice 2014-21 did was define a few things, right? Especially, what is a digital asset? What is cryptocurrency? And oddly enough, the IRS uses the term virtual currency, but then explicitly says that this isn't currency. So it's I'll use that here, virtual currency, as being synonymous with digital assets and crypto. So whenever you hear digital assets, virtual currency, crypto, it's all considered to be the same thing. But essentially, the IRS said it's viewed as property. And typically, the law is behind technology, right? So I still think that's the case. And these rules they've been out there for a while, but they're getting a little stale. They don't seem to represent what the crypto world, the blockchain world really is doing. But essentially, here's how this works. So virtual currency, it's property. It's not terribly different than considering it's something like stocks or bonds, right? So every time I have a sale or exchange of that virtual currency, of that crypto, I have a tax event. The purchase is not a taxable event all it is doing by itself is not a taxable event. All it's doing is establish what your basis is in whatever that underlying asset is. If it costs me, a couple $1,000s, then okay, that's my basis, right? If there's any purchasing cost to acquire that through an exchange, which may or may not be, that would add to my basis as well. But anytime there's a settlement or a sale or exchange of that crypto is when you have the taxable event. We got a little bit more clarity on the law at the end of 2019. The IRS finally came out with some frequently asked questions. They put these FAQs on their website. I think there was 48 or almost 50 of them, covering a bunch of different topics: how to determine basis, how do you, what methods are available to be used when you sell the crypto? Can you use specific identification? Do you have to use the first in, first out method? Do you have to use last in, first out? And there were also some rulings out there for airdrops and hard forks, and those were actually in the form of revenue rulings. So there's a little bit more authoritative guidance on both of those. Now, where these taxable events end up on a tax return depends on how that digital asset is being used. So most people, right, if we look at people, forget businesses for a moment, you and me, right, we purchase crypto, we go through an exchange, we buy it, we hold it there, we have a sale. Those are capital assets to us. We are buying into those for the purposes of investment because we want to make money on it, right? We want a return, no different than when we invest in regular stocks, bonds, and other vehicles through our brokerage accounts. So those get reported on a personal tax return through as a capital asset through Schedule D, which then is supported by the detail of the transactions underneath it on what's called Form 8949. And the split on those forms, it could be 4 different ways. You've got short-term and long-term gains and losses. And then each of those is split one more time between basis that's been reported to the IRS and basis that hasn't been reported to the IRS. Well, because there's no 1099 requirement for exchanges to issue those forms at the end of the year, you're going to wind up on 8949 checking that the basis was not reported to the IRS. On the business side, it ultimately, and it could be an individual that operates their own business. They could have a mining business. But on the business side, if you're entering into a business for profit, those transactions could be capital in nature, but also depending on how you're using the crypto, it could be ordinary. So something I remember getting very popular going back probably about, let's say 5 or 6 years ago, and I'm sure it happened before that, is companies in this space paying their employees in crypto. That's no different than paying them in cash. It's just a different metric to determine the value. That's a business deduction. That business deduction is an ordinary deduction. It's 100% deductible on that business's tax return. So it's important to understand how the crypto is being used if it is in a business, whether that's an LLC, a corporation, or just you or I having a mining business at home. It doesn't make a difference.
You touched on quickly when you're filling out your 8949?
Yep.
The short-term and long-term difference. Can you kind of go into that? I know it's obviously a 12-month holding period, one versus the other for short-term versus long-term. What is the tax impact there? Is like the percentage-wise of capital tax or ordinary income? What would the distinction be there? Because I would think a lot of users are maybe around year-end. They're going to decipher which buckets they're going to be selling, and maybe they're going to decide not to sell because it's in that short-term bucket. It'll be more advantageous to push that a couple months and move that into long-term for a future tax period. Can you kind of go into that component just a little bit?
Yeah, you can certainly do that. That's all part of good tax planning. Again, and you'll hear me say the word generally a lot. That's just the tax person trained into me for the last 15 years. It's the tax person's way of hedging their bets, I suppose, a little bit. But generally speaking, right, you would offset your long-term gains and losses first, your short-term gains and losses second, and then you would net them together, right? If you come out with a net, you could have net short-term and net long-term gains. You can have the same on losses, or they, depending on the makeup, it could wind up with one net result. The long-term gains are going to be taxed generally at a 20% rate for most people, with the potential to have 3.8% on top of that under the net investment income tax. Short-term gains are going to be treated like ordinary income. So they're at graduated rates, which typically are higher, although with the net investment income tax having been around for a while now, some of that gets a little bit wiped out, that advantage, but it is still better to have it be long-term. And for planning and considering what to maybe to sell towards the end of a year for planning purposes, obviously people should work with their accountant. They should work with their finance people, depending on, their situation and what their resources are, or themselves, and figure out what's the best way to harvest some losses, especially with the way the market's been over the last couple of years, maybe, a little bit less than that, I suppose we could say. One thing to keep aware of, though, is that with an individual, you almost want to end up as close to zero as you possibly can. I mean, you can have a capital loss. It carries forward forever. You never lose it. The problem is we have a very short-term view on capital losses under our tax code. You can only take a net capital loss in any 1 year of $3,000, which, given the volatility of the crypto market, might not be very helpful at all to people.
So you touched on earlier the IRS's definition of what they call virtual currency or digital assets. And we're kind of using that interchangeably here. I myself use that interchangeably as well.
Sure.
Probably don't use virtual currency all that much. I think that's an IRS term.
Which is the term, yeah.
Yeah, it's the technical term, but I hardly ever use that.
Yep.
But in that bucket, they also mention stablecoins and NFTs, non-fungible tokens. So I want to hone in on the NFT portion quickly, because I think we covered virtual currency, cryptocurrency. Stablecoins are pretty straightforward when you think about it. So I don't want to spend too much time there. But on the NFT side, how are NFTs taxed if different than anything you previously mentioned? Most people buy NFTs with crypto. I think there are some capabilities, maybe buy it with a credit card, or you can link a bank account depending on who's selling that NFT. But what are the tax consequences if it's any different from a standard crypto transaction? And can you go into things such as, like, is the creation of an NFT a taxable event if I'm minting NFTs? And does that change the disclosure on any of my tax returns?
So to date, NFTs have they're typically not taxed any different than other digital assets. The caveat you mentioned about using crypto, right, to acquire NFTs, right, which is, like you said, is pretty standard. And the reason that is because now you've had 2 steps to your transaction and may have 2 steps to settle your transaction, right? I've got to take my hard-earned dollars. I've got to purchase whatever, let's say I purchase ETH and then go and buy my NFT. Well, let's say I purchase my ETH and I'm sitting on it and it's changed value. I may have a gain or loss based on what I'm able to acquire with that NFT from what the purchasing power has changed, right, over a period of time. So that could be taxable transaction number 1, and then selling the NFT could be taxable transaction, or would be taxable transaction number 2. And then again, if you're not liquidating right away, the third leg of that will be getting yourself back to fiat. So that's the major difference. And I think one of the shortcomings I've seen on various software providers is struggling to get that automated somehow for taxpayers to track their gains and losses, right? I mean, there's 100 different coin tracking types of tools out there, but it does require a lot of organization, good records from the person themselves, and regularly going into those accounts and looking at those gain and loss reports and seeing if there are any transactions that were tagged incorrectly or need the input of the person to say, like, we didn't know what this was. Can you fill us in here, right? Now, that's by no means an official 1099 that, it's okay, this has been reviewed and the IRS is going to get this and it better match up. That doesn't exist yet. We'll get into that, I think, a little bit later. We have a couple things to talk about there. There's a notice that came out in March of this year, 2023-27. The IRS is going to consider NFTs to be collectibles. So that's a separate category within the capital asset rules. And gains from those NFTs would be subject to a higher rate, which is 28% flat, at least as the rates currently sit today. But there's another layer to this too, because that designation isn't going to cover all NFTs. You essentially have to look through at what the property is that the NFT is representing. So if you're in the metaverse and that NFT represents a piece of land in the metaverse, then it's not covered under the collectibles rule, which actually would be a good answer because you'd have a lower capital gains rate if it's held long term. If anybody's going looking for the collectible rules, typical of the tax code, they actually sit in an area that is totally not related to where you'd expect them. There's a definition that's grouped under retirement accounts of all things, right? So, I can't knock the tax code too much because it helps us explain complex topics to our clients, lets them plan properly, and to be honest, hey, it puts food on my table. So, but that's the only change that'll be coming up that I think is going to be significant. beyond that, you talked about creation of an NFT as being a taxable item. Where does it go on the tax return? So similar to what we spoke about a few moments earlier, the taxation of those NFTs depend on how they're used. So we do work with several companies that mint or deal on NFTs, and that's their business, right? So these are typically ordinary business transactions and are not subject to capital gains. So it's important to understand that too. Creating an NFT itself is not a taxable event. However, if you're a professional who mints NFTs full time, you've got to report your income and business expenses, right? If it's not a hobby, and even gains from hobbies get reported as well. That the creation of NFT itself is not taxable, but what you may have is, through the chain there, getting it minted and what it will cost to do that, you'll have basis attached to it that you should at least be used to track as an offset to future gains or sales, right? I guess it could be like a cost of minting if it's not a capital asset.
And I think an important distinction that we should just point out quickly for especially any new users in the digital asset space, which I think is very prevalent for anyone that is holding an NFT just based on where the industry has gone probably over the last 12 to 18 months, unfortunately down. I know
Yeah,
NFTs were a very
you've seen
hot
some of these
topic.
reports. Yeah, I mean, I don't know. You don't know how much these are clickbait articles, right? But you get all those. I'll put it in quotes if anybody isn't can't see me on this, but these business websites, right, that say it's possible that 95% of all NFTs are worthless. I'm like, hey, worth depends on what somebody's willing to pay for it.
Exactly.
So until it's sold,
Yeah.
just a paper loss, right?
And that's that's the point I was driving at is if you're holding that NFT or crypto, right, and you haven't sold anything, but your value from date of purchase to today or
Mm-hmm.
year end has gone down, there's no tax consequence there yet. It's until a sale is triggered. Because I think you and I get questions all the time, right? I bought this NFT for X dollar amounts. It's gone down 90%. I want the benefits of that. And how do I get that? There's none yet, right? And you can work with your tax professional on how to try to harvest some of those losses and get to where you got to get to. But I think that's a good distinction to point out to some users that are especially new in the space.
Yeah, try to find some. Look, if you really are trying to find a way to make that loss real and have an impact on your taxes, then the best case is that you've got some gains that you're able to reduce, right? Because if you just take the losses, we go back to that rule I mentioned around the capital loss limitations. For a person, it's only $3,000 a year, and again, it carries forward forever. But who knows when the heck you're going to use it, right? I mean, so it's a tool there for planning. It's an attribute that you can think about and carry forward almost like an asset, but you don't know if you're ever going to realize it.
Yeah. So shifting focus just a little bit, 2023 on the tax front has been a year of clarity, I would say, just a little bit. We're starting to get more and more guidance. I think that helps with the industry maturing.
Better than other years in the past. I agree. Yeah.
Yeah, we've been waiting, and finally we're starting to get some clarity from the regulatory bodies. So shifting focus to the staking side of the equation, I believe over the summer the IRS issued or published maybe some FAQs or another revenue ruling, I don't recall, around staking rewards and staking income. And I think that it comes at a perfect time where staking has become more prominent in the ecosystem, especially with Ether moving from proof of work consensus mechanism to proof of stake. Obviously, a lot of individuals in the space know Ether as opposed to some of the more esoteric tokens that are on the proof of stake protocol. So I'm curious, what kind of impact should users or let's say traders like you or I, right, just the individuals expect, and how does that get reported on my tax return if I have staking income now? Is it any different than what we've talked about?
Yeah, it's typically not different than what we've talked about. So you're right that there was some guidance on this. It was put out through a revenue ruling, which carries some substantial authority there that taxpayers can rely on. So it was Revenue Ruling 2023-14. It came out the end of July, so you're right on it when you said it was in the summer. It basically says that staking rewards for cash method taxpayers, which is the overwhelming majority of people are cash method taxpayers. Those rewards are included in taxable income when that person acquires possession of the reward under what's called the dominion and control standard. Without getting into the history on that, basically when somebody is able to sell or otherwise transfer their asset, they have the right to it. I often deal with this because you and I both work in the technology space when we work with early stage companies too, and their stock and how they can sell that. And doesn't have to do with the market being there. It has to do with whether that person is the right or ability to transfer that asset. So once that happens, you have your taxable event, and it's the value of whatever that reward was at that point in time that you recognize into your income.
Okay.
And this applies to both, whether it's a proof of stake chain or if it's just additional tokens acquired through like staking on an exchange. There's no difference.
And how would that parlay while staying in the consensus mechanism model, right? So we discussed proof of stake and how your income would get reported and the tax rates. What would that look like if I'm mining Bitcoin, right? So on a proof of work and I have ordinary income, right? Because I believe that's how mining rewards.
Yeah.
Different terminology from staking rewards, but I think it's similar conceptually. Is that accurate?
Yeah, agreed. Yeah, agreed. In my head for a long time, I used to think of staking as being a little similar to interest. It's not in the way it's reported, but it kind of feels that way, right? It's like using what you have to make more of something. It kind of feels like how interest would work in a way, but it's usually that staking reward is typically not a capital asset.
Gotcha. A common question you and I would say receive on a pretty frequent basis, right? Especially as we're rolling into Q4, right around year end,
Mm-hmm.
where people are starting to scramble as they're trying to figure out potential tax liabilities, tax consequences, and just doing some early plan. Well, we say early planning. We try it's early planning, and we're not waiting till the last 2 weeks of December. But as it relates to the digital asset industry, it's pretty common when you have some investors, they invested in a very new token or new NFT. The asset itself appreciated significantly. So a user came into a lot of money very quickly, unexpectedly.
Mm-hmm.
What are some ways I or individuals can potentially reduce their tax burden, right? So if there were certain tips or tricks you'd recommend to anyone, obviously being proactive and planning
Mm-hmm.
and having good records, I would say are 1, 2, 3.
Yeah.
Is there anything else that could help a user when they're thinking about their tax
Yeah,
liability at your end?
I think to add to 1, 2, and 3, it's having a tracking tool software. And like I said, there's plenty of them out there. Always happy to give recommendations individually to people when they ask, depending on their situation. But using that to the best of its abilities, right? So that you can look at what you hold and, hey, if I decide to sell or if I decide to report my sales using highest in value first out or FIFO or specific identification, that may help move that answer, right? That result. You may be able to defer some gains potentially because you hold on to some of those assets a little bit longer if you're using a different method. Another one could be, using crypto for donations. I'll say this about charitable donations. It's always been a very important and popular part of the tax code, especially for, I would think, more high income earners, right? It's the people that are able to itemize their tax deductions, which I'm not going to get into all the details of that, but basically there's a whole group of different kinds of deductions. If you add up everything you have under those categories, and it's more than what the free deduction is that the government gives you, which is indexed every year. It's usually, I think we're at almost 13,000 if you're married, 12,000 and change, half of that if you're single. Those charity donations will be valuable because generally charity donations, the deduction is based on the value of what you've donated as opposed to the basis. Now, there's some, again, this isn't a charity podcast. I don't even think I'm the right person to get into that detail if we ever want to talk about it. But there are rules around appraisals depending on what the value is of that crypto that you've donated, getting the right records together, and so forth. Most of us are probably doing our donations the traditional way, which is we donate to some type of cause, right? And it's an organization. They give you a letter that says, okay, we recognize your donation for X amount, or it's you're donating clothes. I can't tell you how many times, Mark, you have one kid. I've got 3. I'm sure one day we'll talk about this a little more, but I can't tell you how many times I stuff bags into the back of my car with clothes that the kids no longer fit into. and take that down to one of those boxes, outside of Lowe's or Home Depot and drop that thing off. And then I go do my taxes, and there's a guide that you can download with TurboTax and other software that basically says, hey, is this shirt in good shape, bad shape? Is it a man shirt, a girl? And next thing you know, you've got some charity donations without having to do a lot of extra reporting. I think that's where most people are taking advantage of it. For crypto, I don't see it as frequently, but that doesn't mean it's not a tool that's available to people to help reduce their tax burden.
Yeah, and I think consulting, right? I think it's there's definitely benefits and ways to limit your tax liability through that means. But I think planning out ahead of time, right before year end, is key there.
Absolutely.
So turning the page slightly, unfortunately, to probably a topic that many people have been scarred by, but I think it's important to know as it has impacted the digital asset industry, and I want to dive into it because people have probably some impact as a result of the FTX situation,
Sure.
BlockFi, Voyager, Celsius, some of these platforms that have declared bankruptcy, and now my assets are tied up, they're frozen, I no longer have access to them. What can I do? Is there, I don't want to say the word benefit, but is there any tax benefit there around some of those assets that I frankly no longer have, don't have title to? Maybe I'll get some back during the bankruptcy proceedings. Who knows when that will happen? But can you go into that quickly around what users would have if they have assets tied up? And particularly from your point of view as a tax professional, what records would you need to see to help get that onto a 1040, right? You don't want people just throwing around arbitrary figures.
Sure.
FTX went belly up. I lost $100,000. So I'm going to take that. Like, what would you need to see that would hold up almost under an IRS audit?
Sure.
So just curious what the impact would there be.
I think of that, there's technical and then also kind of the practical solution to this too. But so I would say it's tough to claim in a worthless security if you're not sure if you're going to get that back, right? So if things are frozen or locked up, it's tough to say it's worthless because we're still in the process of this all sorting out, depending on the situation, of course. So it may not be worthless yet. If that's the case, and you've got paperwork that comes from the exchange, it says, hey, none of your assets are recoverable, that may be good enough. On the other side, you could claim an abandonment from that property where, hey, I believe this is without value, so I am relinquishing all rights to this asset in the future. So even if for some reason it did have some residual value, it's no longer mine. So I've discarded it, right? And there's no future trades attached to it. So I've now cemented that loss, right? When you're reporting this on your return, again, not many exchanges will voluntarily issue 1099-Bs because typically they don't have to. So you're going to claim the loss on your return. It's generally going to be a capital loss. It's generally going to be subject to that $3,000 limitation. So there's still planning that has to go into this stuff. But if you didn't get a 1099-B, that clearly showed this, right? So here's some of the things you can do. Keep a record, the date you acquired whatever that crypto is, what it was, how much it cost you, the amount of units you acquired. I said the cost basis, of course, the date that you disposed or considered it abandoned, and then the amount that you sold it for, which presumably would be zero because you're saying that it's worthless, right?
Now, when I'm thinking of filling out my 1040, right, there's a lot of different inputs, especially from a digital asset component. I believe it was 2-3 years ago. I forget when the IRS added that explicit question at the top of your 1040. At any time during the year, did you receive, receive can be multiple terminology, right? It was a reward, income, payment for services, etc. Or did you sell any digital assets? Now, many people come to us, like I myself included, I'm a long-term holder, believe in the industry. I'm not really selling. So if I'm just purchasing during the year, do I need to say yes to this? And then conversely, what are some of the, I guess, penalties from the IRS if people were to say no and then they get discovered as actually, yes, you did have digital asset activity, which I'm sure many, many people do in this space, right? They don't want to let the IRS know I'm not in crypto. No, they don't. How are they going to find out? Well, the IRS will find out some way or another. They typically do.
Well,
Just a matter of time.
yeah, through John Doe summons and other ways to try to extract data from exchanges and get people's information. They've been able to do some of that, and they've also, they went through a campaign where they were issuing letters to people they believed were involved in crypto. Some of them more harsh than others. Some of them were, "Hey, we think you might be." Others said, "We have information that says you've been involved in cryptocurrency. Please respond to this letter within 30 days." Right. So those are a little bit more serious. So there's two parts to what you said there I want to address. So first is, the question at the top of that of your 1040, right? Did you receive as a reward or payment for property, et cetera, or sell a digital asset? If you're just having a year where you hold and haven't done any type of transactions, I guess technically you don't have to check that off. But if you've already done it in the past, what's the harm in doing it for that year, right? I personally, I'm not saying that is the technically correct answer, but what is the harm in just being above board and report and just checking that box, even if you held crypto for the year and you're not somebody that is trying to skate around the rules. Now, if you do skate around the rules and you check no, and it's later determined that you did have crypto activity during the year that would have impacted your tax return, well, you run into a whole host of issues, right? So, underreporting penalties, willful neglect, fraud. There's a lot of different issues that can come from just having an incorrect tax return and then owing tax to the IRS via audit or notice. Another issue could come about. You think you're in good shape all this time. Hey, it's been 4 years since I said no to this box, even though I knew it was yes. Depending on the magnitude of the understatement of income that you have, the statute of limitations, which generally is 3 years from the later date of filing a tax return or when it's due, could be replaced by 6 years. So as professionals, we have to say, look, even though it may people don't want to pay taxes, it's certainly going to be a bigger issue if you do not. And from our perspective as professionals, ethically, if I know that you've lied to me, I don't have to do the level of diligence maybe, let's say, as some other regulatory bodies might have to do, but I'm not going to sign that tax return. So now you got to go find somebody that's going to help you. And that might be difficult to do.
Yeah, and to your earlier point about why say yes if you have done it in the past, right? I was thinking more so on the opposite side of that is if I said yes in the past because I did have a sale, so I wanted to report that, and maybe this year I'm just a long-term holder, does it raise a red flag if I say yes and I didn't have any transactions and don't report anything? And the IRS is like, these two stars don't align here. You're saying you had virtual currency transactions, but there's nothing here.
Yeah, it could. I've seen that kind of like the proving the negative, I guess. I don't know how to put that.
That's kind of where I was thinking about it from. But I get your point where it's like,
I've seen
you've done it once. Why? Yeah. What are you changing up for? Yeah.
Yeah, and what I meant was if it's consistently where you've had transactions, I'm okay with being above board and continuing to check that box. It's certainly better than the opposite scenario.
Yes.
But it is a good point. You're right. If you've been doing the right thing all along and then you have a year where it doesn't apply, personally as a taxpayer, I'd feel more comfortable if I either filed my own returns that way or asked if I could do that with my tax preparer.
Yeah. Okay. And then I think to really put a button on today's episode, one thing that I don't know if we've seen much traction on, obviously it's been a good year for taxes from an IRS point of view and getting some clarity. But one thing we're still waiting on is a lot of users, your common mainstream users of digital assets that are holding on a third-party custodian on an exchange or a brokerage account as we're getting more and more larger institutions in the space, like Fidelity, Charles Schwab's entering, et cetera. And you can't really take those assets off platform. Do they have are there any requirements from any exchanges right now to issue any 1099s? Is that expected to come out in the future? What should users expect? Because, right, record keeping is number one. We want to make sure we're keeping our own records. While if I'm stock trading, I just rely on whatever my brokerage tells me, right? And that's what I'm reporting on my 1099. I don't have to do the manual work myself. Has that changed with crypto? Is that expected to change? What's the future there?
Well, as a tax professional, I'd love it to change because it would make our lives a little bit easier to be able to help people not only make sure we're reporting things correctly, but also be able to understand, like there's records of this. You said your basis was this, but guess what? Now I know for sure it is that. It also might put a little bit of not a little bit, I take that back. It will reduce the time that an investor or taxpayer has to spend managing all this themselves. So, right now, there are typically no requirements for exchanges to issue 1099-Bs. I think the opposite happened in the past, where some exchanges were trying to do that proactively and just did not have the right records to make it accurate. And then there was a whole situation with a few exchanges, and people listening to this may have gotten them, where they're issuing 1099-Ks, which just report the gross value of all transactions. And that's problematic because the IRS is going to get that, and especially with the volatility over the last couple of years, both up and down, might say, wow, you had $1 million in transactions. Like, how come I don't see this in your tax return? Well, we both know that. I could have spent $1.5 million and had a $500,000 loss. I could have spent $1 million and had no gain or loss. So, I've seen less and less of this happening. I think most exchanges have stopped doing any 1099 reporting. And you've even seen some that, even the tracking software is a great example of it. Many of them will have the ability to pay for an add-on feature, and then they can give you a tax report, a gain loss report. They don't put Schedule D or 8949 or 1099 into the language. They seem to be very calculated and careful in doing that. All that being said, we had the infrastructure bill come out. God, I can't remember when it was. The last 3 years feel like they blended together into 1 year for me and for most people. But I think it was in 2021 the infrastructure bill came out, where there's proposed regulations coming to lay out groundwork for exchanges, brokers to have to issue what will be called a 1099 DA for digital assets. It was supposed to come out, I believe, next year, and now it looks to be pushed to the 2026 year, which would cover the 2025 tax reporting period. So there's got to be mountains and mountains of obstacles that have to be overcome to get this done correctly, which why pushing it a few years makes a lot of sense. But if it's rolled out effectively, it could be very valuable and help. It'll get the government the proper reporting, but it'll also help me and other tax professionals and investors get the information that they may just not know. So, we'll see where that goes, and that may be a topic for a future podcast, a presentation, a speaking engagement, or something, because it'll be here before we know it.
Yeah, and I think we'll all be appreciative once it comes out, assuming it's rolled out effectively. I think that's the goal, right? And it continues as the industry is maturing. We're moving in the right direction, which is all I can ask for.
I think so. Yeah, I also think, too, some of the volatility over the last couple of years may just be all of the supply and demand, right? All of the options, coins, tokens out there. What's valuable? What's not? I place value in a Bored Ape. You don't place value in a Bored Ape because it's super expensive. Then the ones what was the news the other day? Justin Bieber's Bored Ape or whatever has got no value to it. It's just so. I think in the future we'll get to that spot where there's less players involved and more legitimacy, like that the public views for just blockchain and crypto as a whole.
Yeah. Awesome. Well, I think the key takeaway here, we covered a lot today. For any users in the space, individuals, companies, what have you, record keeping is key. I think keeping good records, keeping documentation over your wallet, your transactions, using a software to assist you in this is paramount. And tax planning, tax strategy, get on top of that sooner rather than later for everyone, because there are certainly benefits that users can reap from that. So Ryan, I thank you for joining us on today's episode, bringing your expertise and insight to a very complex and pretty constantly changing environment and industry. I know from your perspective, I'm sure it's not easy to stay on top of all these changes. The industry as a whole is constantly evolving. You mentioned there's 1 million tokens, right? It's every day there's something new popping up. So it keeps our jobs interesting, that's for sure. So I definitely appreciate you taking the time and sharing your insight.
Thanks for having me, Mark. And I'm sure we'll talk to each other many more times before even the weekends.
Awesome. Thank you.
All right, Mark. Bye.
All views expressed in this podcast by Mark Eckerly or his guests are solely their opinions and do not reflect the opinion of Withum. This podcast is for informational purposes only.